Good evening to one and all from Faculty Research Cell, Samshodhana, School of Commerce, Jain deemed to be University, Bangalore. Instructions to the participants. Participants need to be present for the entire session. Participants can post their queries in chat box by the end of the session. A feedback form will be shared during the session in the chat box. It should be submitted by the end of each session. We had a great session by two speakers yesterday. The first session was by Dr. Prasanna Chandra, Director of Center for Financial Management, on the topic Commandments of Investing, which was very well received by the audience, which gave a detailed overview of choosing specific investment as well as the different aspects of controlling. Simple steps for decision making and managing risk, trading practices, and points of investment success. The second session was delivered by Mr. George Littlejohn from London, UK on green finance, which gave us a lot of insights on the topic. He gave an overview of SEC, disclosures, announcement, and aligning investor values with investments with the rise of ESG. Welcome back to the third day of Global Summit. On behalf of Faculty Research Cell, Samshodhana, School of Commerce, wing of Jain deemed to be University, would like to extend my hearty welcome to the speakers for the day. Let's have a glance about the eminent speakers of 5 days Global Summit. Over to you, Sharmila ma'am. Thank you, Sharmila ma'am. Given a 10% chance of 100% times payoff, you should take that bet every time. Jeff Bezos. Most people dismiss many of the best and most profitable investment ideas simply because they probably won't work. These investors never stop to consider how much they could make it if unlikely outcomes actually occur. Jeff Bezos took these bets and became the richest person in the world. We are now moving towards our first session of third day Global Summit, a session on the global securities market, the changing landscape. I request Dr. Megha Garud, Assistant Professor, School of Commerce, Jain deemed to be University, to introduce our first speaker for the day, Srimati Deena Mehta, MD and CEO, Asit C. Mehta Investment Intermediaries Limited, first female member of Bombay Stock Exchange, who will be delivering a session on the topic, the global securities market, the changing landscape. Over to you, Dr. Megha.
Thank you, Dr. Rani Ahmed. The promoter of Asit C. Mehta Group of Companies. The promoter of Asit C. Mehta Group of Companies.
Ma'am, if any two devices are logged in, just check.
No, I don't. I have only one device.
Not you, ma'am. Megha, ma'am.
Ma'am, is it okay now?
Yes, it is better. Yes.
The promoter of Asit C. Mehta Group of Companies, Srimati Deena Mehta, is on the board of Reliance Asset Reconstruction Company Limited, Reliance Home Finance Limited, Reliance Commercial Finance Limited, and Gandhar Oil Refinery India Limited as an independent director. Srimati Deena Mehta was the former president of Bombay Stock Exchange and has the honor of being the first president director on board of BSE, as well as being the first women president. She's also a former director of National Payments Corporation of India, NPCI. She was the promoter director of Central Depository Services Limited, as well as South Asian Federation of Exchanges, the Association of Stock Exchanges of SAARC companies. She has been an invitee to International Securities Regulators Organization and a member of the Index Committee and Advisory Committee on Mutual Funds of Stock Exchange. Member of SEBI committees such as a review of eligibility core norms of SEBI, derivative committee, delisting committee, ethics committee, and investor education. A warm welcome to you, ma'am, requesting you to take over the session.
Yes. Thank you very much. I'm indeed honored to be a part of this platform to talk to all the students. I presume most of them are students, about the stock markets. Actually, it's a global summit, but of course, I will focus more on India, and we'll talk about how the entire market has evolved in the last few decades. I have been part of the markets for almost 4 decades. So 4 decades history is in front of me. And prior to that, whatever is there, I have studied on my own, and I have tried to understand the entire evolution of markets as they are today. So I think we'll talk about essentially the markets, how it was functioning, and what used to happen in the markets and what happens today. We'll talk about the participants, how the participants have changed and evolved over the few years. We'll talk about the type of companies which have been listed and how the entire infrastructure has been changing throughout. And of course, we'll talk about the market practices, and not to forget the investors, how investors have been investing and how they have changed over the last few years. So I think in a period of about 45 minutes, I'll try to cover as much as I can. Of course, I'm very passionate about the stock markets. I love the markets. I love the volatility. I love the versatility, and I love the sensitivity that is there in the market to everything that happens in the world. So I think every event in the world, be it in the smallest country or the biggest country, gets reflected in the stock market somewhere or the other. And there is a chain reaction which brings out change throughout the world. So I think that is the power of the markets, and they are quite fascinating. So I would really congratulate all the students who have joined this course, and I'm sure that it will be very fruitful and very gainful, I would say, if you really associate with the stock markets on a continuous basis. This is one relationship where you have to stay engaged throughout. It is just like a marriage, where in the marriage, the engagement of both the parties in order to have a successful marriage is necessary. So same applies to stock markets also. You may buy when the markets are high, you may buy when the markets are low, you may sell when they are low, you may sell when they are high. The index is completely zigzag. So every time it goes up, it has to come down. And every time it comes down, it has to go up. So that is the kind of, opportunities, because every rise or fall is an opportunity so far as the market is concerned. So with so many opportunities being available for the investor, I would say that I do not think anywhere else in the world or any other market you would get these kind of opportunities. And the phenomenal infrastructure which has been created by the exchanges, especially BSE, we will see, is that it has made the participation of each and every individual very easy, very convenient, and very safe. I think very safe, that word needs to be underlined, because the kind of regulations which are there today, they are all there to really safeguard the investor. And if at all the investor loses money, there is a lot of greed and fear, which leads to that loss. Otherwise, a very balanced and proper individual would never lose money in the markets. So, as I said, markets are very fascinating for me, and I can talk for hours as to how they fascinate me. And I would also like to apologize because I have been last 2-3 days, I have been suffering from a cough and sinus. So occasionally I will cough. So please bear with me. So I will start now with which is my favorite topic, and which is the history of markets. I think you all must be aware that the first stock market set up in the country was the Bombay Stock Exchange in 1875. In fact, the Cotton Stock Exchange is set up in 1874. And it is very well known that the Bombay Stock Exchange was set up under a banyan tree. But let me tell you that this banyan tree is not very unique to Bombay Stock Exchange because the Tokyo Stock Exchange, New York Stock Exchange, and some European exchanges also, they have all been set up under some tree or the other. So it was some Burton tree and different kinds of trees. So basically, I think when the stock market started, people used to get together. And when they got together, they needed a shade. And since there was no premises or anything available, they all assembled under a tree. So most of the stock exchanges all over the world have been set up under some tree or the other. And BSE was also set up under the banyan tree. And 1875 was the period when the Suez Canal had opened. And between 69, 67, the American Civil War was going on. And when this Civil War was going on, what happened was that lot of, whenever there is a war, a lot of goods are demanded because so many things are required for the soldiers. They are on the forefront. Then there are emergency supplies to be made to citizens and whatnot. So as a result of that, a lot of companies got set up in India during that period. Of course, they were all under the British Companies Act. The Companies Act, which was in Britain because India had not become independent. So we had a lot of cotton companies which were set up. Then we had a lot of railroad companies which were set up, and we had a lot of banks which were set up. So, you see some Bank of India, Central Bank and all are very, very old banks. And I remember, Swati Piramal had brought the share certificate of Morarji Mills, which was, I think, one of the first companies which were set up during that time. So there was a lot of demand for cotton. Then there was demand for money. Banks were set up, and there was demand for movement of goods. So a lot of railroad companies were set up. So that is how the stock markets, started functioning. And between this till independence, there was, of course, the markets were essentially ruled by speculators and by the company promoters. So there were no retail investors as such who were participating in the markets during those times. And as we move fast forward, I would say that the markets have had a lot of ups and downs. There have been ban on forward contracts. There have been Gold Control Act. There have been ban on dividends. And I remember when there was a ban on dividend, some brokers who were there quite some time back, they actually all returned to their villages because nobody wanted to deal in the shares. So that kind of phase also the markets have gone through when the markets completely closed down and there was not much activity in the market and people chose to go away. But I would say that, of course, the markets, they survived. They were there all the time. And Mr. Gigi Boy, the building, BSc building is named after Sir Gigi Boy. He was there for almost 40 years in the market. Between, I think, mid-40s till right up to mid-80s. And he single-handedly ruled the exchange. If you go to the IMC library, you will see a lot of correspondence books and correspondence which were between him and the Ministry of Finance. Because brokers were really, blamed for a lot of volatility in the markets. And huge amount of correspondence used to happen, and it is really very interesting as to how Mr. Gigi Boy, he used to, fight back and see to it that the markets were run smoothly. And in fact, he had such a fantastic reputation that if any broker got summoned by him, brokers used to really fear going to meet him. So those were the times when Mr. Gigi Boy was there. And first major, I would say, participation of retail investors in the market happened in 1974. That was the time when Mr. George Fernandez, he was the commerce minister, and he came out with a regulation saying that no foreign company will own more than 40% shares in any company. So what happened was that, some companies, like I remember Hindustan River, Richardson Hindustan, which is now Procter and Gamble, Cadbury, which was Hindustan Cocoa earlier. So all these multinationals, they all were compulsorily made to dilute their shares. And when they were made to dilute their shares, there were some companies who chose to go away. For example, IBM and Coca-Cola, both these companies exited the country. They said, no, we do not want to do business over here. And I think they came back only in mid 90s, around that time when the liberalization was announced by the government. So all these, this huge turmoil happened in the companies in 1974. And people who could actually understand the stock markets, they really bought the shares, because at that time we did not have the free pricing like we have today. So at that time, what was there was Controller of Capital Issues, or CCI as it was called. I think Mr. D.R. Mehta was the last Controller of Capital Issue, and subsequently he became the chairman of SEBI after the office of CCI was closed. Now CCI had a formula, by which they used to decide what used to be the share price. And the formula was so skewed that a share whose value is 100 rupees was available maybe at 10 or 15 rupees. And that was the rate at which the company was forced to make a issue and sell the shares to the public. So you can imagine that people who bought those shares, they really minted money. I remember one gentleman, he really understood the worth of all these shares. And I think when he retired, all the shares he had kept with him of all the multinational companies, and I think almost 1,000 crore worth of portfolio he retired with. And I also remember one gentleman, one Mr. C.V. Raman, you must have heard of him. He was chairman of BARC. And he got C.V. Raman award of rupees 10,000. And he kept he bought shares of Richardson Hindustan from that 10,000 rupees. And sometime in late 90s, he called me. He said, look, I want to buy a house. I want to sell these shares. Please sell off everything and see to it that I get enough money to buy a house. And you won't believe, only 50%, he had not even opened the packets from where the shares had come. And almost 50% of the shares only I had to sell for him to get some 80 lakhs or 1 crore rupees so that we could buy a house. So you can imagine, how the investors who took part in the stock market, in the company dilution during that period, they all really made money. And after that, what happened was Mr. Dhirubhai Ambani happened. And we all know that, Reliance share was really the star performer so far as the market is concerned. And, Dhirubhai came up with a lot of series of shares like Reliance F, Reliance G. And, these shares would get converted and they became the main shares. The difference between these shares was just dividend of 1 or 2 rupees. But actually the shares were quoted at 20, 30, 40 rupees difference. And, there was huge money to be made because people would, just buy the shares and keep it and wait for the conversion to happen. So after the dilution of FERA dilution, Dhirubhai Ambani, he really ruled the market, and Reliance was the star. And some old brokers, they tried to, corner him by short selling his shares and all. And it is history that, Dhirubhai refused to square off the badla, and as a result, everybody had to pay a very huge penalty. And after that, they stopped playing at the Reliance shares. This is written in the book which Kokila Ben has written about the life of Dhirubhai. And I was also personally, I am very fortunate that I had very close interactions with Dhirubhai. And Dhirubhai used to sit with a pile of share certificates. And if anybody would come to meet him, he would actually sign a certificate and give it to him, saying that, look, this is the share. And if you keep it, you can really gain a lot of money. And Dhirubhai was the first person to have annual general meeting in a stadium. It was the first time that the meetings were held in the stadium. And, he used to tell me, at least for the first 2 years, he used to say, ask me the toughest possible questions. So 2 days prior, we used to practice on me asking him very tough questions and he replying them. So he took his, role as a company promoter very seriously. And if you would go to the AGMs of the Reliance, there will be so many people who will come touch his feet and say, oh, thanks to you, my daughter got married, I could buy a house. So Reliance was the star during that period. And in mid-80s, we can say that there were a lot of new issue companies which came out. There were a lot of companies from Hyderabad like United Group and Rayalaseema Group. Then there were a lot of new issues, these 6,000 listings that you see on the Bombay Stock Exchange, a lot of them came about in mid-80s. After that, Harshad Mehta happened. Harshad Mehta had a theory that any share should not be valued at whatever intrinsic value. It should be valued at a replacement value. What he meant by replacement value is that this X company has, say, 100 crore, book value of the assets. But if we were to create a similar company, then it would cost 1,000 crore. So he said that, the actual value of this company is not 100 crores, it is 1,000 crores. Though, of course, there were a lot of defunct companies also like Scindia Steamship, Mazda Leasing. These were all defunct companies and they did not deserve to get a 10 times valuation. But anyway, it was Mr. Harshad Mehta's golden touch, which really, drove the share prices up and up. And of course, Mr. Harshad Mehta, he tried to rig up the market by borrowing money from banks. Of course, we do not know ultimately what happened because those cases have not been decided and Mr. Harshad Mehta is also no more. So after that, we had a leasing company boom. So all hundreds of companies from Ahmedabad, they sprang up saying that, in leasing companies, you get 36% returns. So a lot of leasing companies came and obviously which business can afford 36% returns? And all those companies went down the drain. After that, Ketan Parekh happened. Ketan Parekh had this thing of ICE. ICE is information, communication and entertainment. So he said that, ICE is the future. So he got Mukta Arts, Mr. Subhash Ghai, then Mr. What is his name? Jitendra Kapoor, and that is that Balaji Films. And he got Subhash Goel of Z. All these companies, he got them to list on the exchange. And I remember in 2000, 2001, all these companies got listed. And there was general euphoria that the entertainment companies will do very well. Communication companies, which included BPL, Videocon, all these companies were completely ramped up. And of course, a lot of money was borrowed from Calcutta market, outside the market. So as a result of it, once the entire, the prices, the shares could not be funded anymore. So all the prices, they crashed and we had a Ketan Parekh scam. After that, between 2003-04, I would say that the market shifted from a personal dominance to a value-based kind of investing, because we had Dhirubhai Ambani, not in a negative way, but he was a very, very domineering figure, and whatever he did, actually, that is how the markets moved. Then we had Harshad Mehta, then we had Ketan Parekh. But after 2000, 5 onwards, huge amount of participation started happening from FII investors, and the market became completely value-based kind of market. And during that time, one is the depository was set up, then the automated trading, it started in NSE as well as in BSE, and the exchanges in 1998, they came up with the trade guarantee funds. That means each and every transaction was guaranteed by the exchange, and as a result of that, there was so if you look at it from another point of view, for the investor, there was mal ka safety. That means you get shares from the depository. Unlike the old times, you get physical shares where there is a problem of signature differ, all these things, those problems are not there. So you have mal ka guarantee, you have bhav ka guarantee, means rate guarantee. That means that because of the automated trading system, anybody sitting anywhere in the country, be it Jhumri Talaya or be it Bombay, you would get the same rate, very, very fine, best rate you will get in the market when you go to buy the goods. And third is the depository system, it guarantees the money. See, earlier what used to happen is that in absence of a trade guarantee fund, there was a problem, because if any broker defaulted, then we had to unwind all the transactions. So if I had traded with you, and if you defaulted, then you had traded with someone else. So when one broker would default, then behind that maybe 10, 20, 15 more will default. And this actually happened in 1993 when there was a Kuwait war crisis. At that point of time, what happened was that almost 40 brokers, they defaulted, because the entire crisis was so bad that the share prices fell. And exchange did put curbs on, how much the market can fall. But unfortunately, how water finds its own level, the share prices also found their own level. And the transactions were being done much below the market price. So almost 40 brokers were going to be declared defaulter, of which, exchange, I was part of the defaulter committee at that time. So what we did was we gave a 15 lakhs ka loan to the brokers and told them that in a limited 1 to 2 month period, you please pay this money back to the exchange. And 4 brokers, they had no means to pay the money. So out of 40 brokers, 4 were declared defaulter and 36 survived. But let me tell you, I sometime back, I did a security law. For that, I wrote a paper on what happened to these 36 people who had, escaped being declared defaulters. And you will not believe that in next 10 years, by 2001 to 100% of these 36 members were declared defaulters in next 10 years time. Why did it happen? For the simple reason that once you lose money on the stock market, it is very difficult to gain the trust, because once you have lost, everybody looks at you with distrust, and they do not trust you with their money, their goods, their shares, and you again end up becoming a defaulter. This is a very, very strong lesson that as brokers, sub-brokers and all, one needs to learn on the subject, that once you lose the trust, it is very difficult to keep standing and keep doing the business. So we come to a situation where the trades were guaranteed. So for every trade, if 2 brokers traded, for each broker, the trade guarantee fund would substitute itself. And I'm proud to say that since we have introduced the trade guarantee fund between 96-97, and today we are in 2022, close to 30 years we will be finishing. Let me give you some idea about the turnovers. In pre-Harshad Mehta time, the turnover was 200 crores per day. During Harshad Mehta time, it was 600 crores per day. And today we are 4 lakh plus crore turnover per day. 4 lakh plus crores turnover. So you can imagine 204 lakh plus. But since the trade guarantee fund has come, Bombay has had riots, Bombay has had floods, Bombay has had power failures, but never ever has there been any default so far as the payments to the exchange is concerned. So it is a perfectly safe and wonderful system. I do not think any other business in this country offers this kind of safety and security in doing your transactions. If you sell, you will definitely get your money. If you buy and you pay for it, you will get your shares. There is no problem. Even the Depository Act has been drafted in such a manner that that once the shares goes in depository, it becomes fungible. Fungible means you cannot segregate it and say that, oh, I have a court stay on this or something like that. The shares are fungible, so you have 100%, it becomes your 100% your property. And because of trade guarantee fund, custody system, depository system, and the online trading system, a huge amount of interest was created by the foreign investors. And the G57 or 58, I think, 57, 58, one of the numbers, all those countries, they certified that, yes, now with these three things happening in India, we are ready to permit FIIs to invest in these countries, and it is a investable grade country now. And that is how, of course, we also changed our arbitration laws. We brought them in line with the International Arbitration Act, and that was very useful. And of course, new laws were formed, that is DIP guidelines. New guidelines came in 2001. Fraudulent and unfair trade practices law was the takeover code was revised. And so as a result, SEBI got lot more power, and strong laws were available so that one could insider trading guidelines. So one could really say that Indian regulatory system and the Indian stock markets and the entire infrastructure that goes with the stock market has come of age. And since 2004, there have been never looking back of 1 or 2 years, maybe funds have gone out. 2008, we had a crisis. But let me tell you, so many crises have happened, but never ever has the stock exchange system failed or the trade guarantee system has failed. So this is so as we stand today, we have got, because of the corona and all this happened, the investor population has increased substantially. We talk of brokers having, lakhs of investors are getting added, and so many new brokers have come. Internet, digital technology has advanced quite a bit, and it is very easy for investors to join the market. So one big change that we see is on the front of investors. How many investors were there? In the old times, they were maybe 30 lakh, 50 lakh, 1 crore. In derivatives, there are fewer investors who are trading. But net, the stock markets have, people have started understanding that it is advisable to invest, not keep money in fixed deposit, but invest in instruments like equities, mutual funds, etc. So that is one big change that we have seen. Of course, the another big change so far as the participants are concerned is that the high frequency trading has started. We have got algorithm trading, we have high frequency trading. And let me tell you, I have attended seminars abroad also, and I read a lot of articles also. Still, the automated trading systems are a big black box. And I'm really not sure whether how much the stock exchanges, the SEBI and others are equipped to understand what is happening inside the automated designs, the engines that have been created by foreigners and everybody. I mean, the APIs of leading brokers are available, and you can just do anything. So with those APIs, you can try various strategies. You can You can, automate your own trading and try to capture differences, try to capture, inefficiencies so far as pricing is concerned. So all those things are really prevalent today. I do not know how dangerous they are, and of course I will not talk at length about the black fiber entire scam that we heard about. It is essentially trying to capture those few nanoseconds before anybody else, and the kind of gains that people make, I mean, they are phenomenal. So this is one what we call as black boxes, which is taken over today. I think that is a very dangerous thing so far as the markets are concerned. And going forward, I would say that more and more such things are going to come forward, and the SEBI as well as exchanges and everybody needs to create the expertise to really regulate this kind of trading which is going on. Of course, along with this, there is dominance of derivatives trading. Actually, derivatives trading should be depending on the cash market prices. Normally, derivatives trading or futures trading, if you have to price it, then it is the cash price plus certain carry cost, and that is the derivatives price. But the derivatives volume being 80, 90% almost of the total market. Today, what is happening is that the derivatives is in its own orbit. And only at the month end, when there is a square off which is going to happen, only at that point of time, we see that they come too close to the to the cash prices. So it is kind of an artificial kind of correction which happens in the prices at the end of the month. And and the dominance of derivatives, is in the markets is highly speculative, and according to me, it's very worrisome. Because derivatives is primarily a hedging tool, but the way it is being used, where hedge funds and others, they try to skim the market of differences which are there, in terms of calendar spreads, in terms of cash versus derivatives, in terms of across exchanges. And of course, as I said, there are so many other things which are being tracked, and we do not know what kind of advantages people are making in the market. And as a result, there is no transparency, and whether how much harm they can cause to small investors, retail investors, by just being having money and being technologically advanced, by having your servers inside the exchange. All these things are creating, I would say, the democracy so far as the investors is concerned is not there, and small investors are really put at a disadvantage. So when it comes to evolution of products, I think derivatives has been a big bull, or rather in the China shop, it is there all along. Of course, currency trades have also started in a big way. We have got interest rate futures which are happening. Then we also have commodities, and commodities are being traded in a big way. Of course, they are nowhere compared to equity derivatives, but the kind of interest which is there in commodity derivatives also is not small. So currency, commodity, all these instruments are basically designed for people to, like, if you look at currency derivatives, for exporters, importers, they have to hedge against their payment and receipt positions. That is why currencies are there. But let me be very honest and tell you that when I used to, have very active currency desk, commodity desk, at that point of time, not even out of almost 2,000 customers, not even 20 were doing actual hedging. Everybody was, basically indulging in speculation only. So these markets, how much they have, volumes have gone up. They are very safe, technologically very advanced, but how much they are contributing to wealth creation is what is really needs to be looked into, because what is the role of stock exchange? The role of stock exchange is to bring the household savings to the corporate sector so that they can use it productively and create assets for the country. Unfortunately, these things are not happening. I mean, it's very worrisome that the role which is envisaged of the stock exchange by becoming corporates, by becoming, profit generating companies, tax paying companies. I think the whole purpose of it being a utility company and it providing a platform to divert the resources of the country or of the savers. We are a very large saving nation, and putting money in your bank is the stupidest thing that you can do. With the inflation which is there, your value of money is going to go down only. So, in such a country where mobilizing of these savings is necessary into productive arenas, we are, the most popular platforms are the derivatives trading platforms, and not much people care for the investors and for wealth creation. I think wealth creation is something that must happen. And next most important thing is the popularity of the stock markets must go in every household. Today, how many investors are there? Though 10 crore investors are registered, actually the number one broker has got 80 lakh customers. That means, unique customers, if they are only 80 lakhs, unique may be less also. If only so many people are going to trade in a population of 127 crores, I think the entire infrastructure and the thought with which we have created it to really mobilize the retail investor saving, I think that purpose has totally failed. I would say that every SEBI chairman who comes, I strongly believe that they must be given a target to increase the number of investors, to increase the depository accounts, and make the entire KYC process so simple that so many members, just like the Jan Dhan moment which happened in India, similar Jan Dhan moment should happen in the stock markets as well as in the depositories, so that huge amount of savings get mobilized and people participate in a very big way. We have got very good mutual fund in the industry in our country. We have got such experts who are guiding in these mutual funds. I think all these resources are at the disposal of retail investors, and we hope that all of them really benefit the citizens of this country. So I will stop here on this note, and let us open the questions to the audience.
Thank you, ma'am, for sharing your views. The participants can now ask their questions in the chat box. The link for the feedback form will be sent in the Zoom chat box and YouTube description box. You are requested to fill it and submit it by the end of the session. Now you can post your questions in the chat box. Ma'am, there is a question from Mr. Sudarshan. He's asking, after Ashok Mehta scam, people feel hesitation towards stock market. After scam 1992 series now, youngsters got interest towards it. What is your thought on this?
No, I think now 1992 scam is long forgotten. The scam was hardly 500 crores, which was involved in the entire scam. And if you look at today, the turnover is 4 lakh crore per day. So I think for that point of time, it was a big number. But today, it is, I don't think people really care about so much about it. And I think scams apart, it is the investor who has to invest in a very disciplined manner. According to me, no investor can lose money if he has a stop loss in mind and if he has a fixed target of how much he wants to earn. if that kind of target he works with and he's scam, he will definitely achieve his target.
Okay. Next question is about what about NSE scam? Yes, Bhapna is asking, what about
I think
NSE
you
scam?
can read you can read about it. I do not know a small investor who wants to invest 1, 2, 3 lakh rupees, how much he is going to get impacted by this. I think you should not worry about this. Scams are part of our life. I think BMC people going on a strike and not cleaning your road for 3 days, that is also like a scam only, where you are denied the services. I think we need not worry about these things, because we are too small, and I'm sure that we can take care of ourselves, scam or no scam.
Okay, next question is from Mr. Harsh. Is asking, what are your thoughts on nowadays IPOs?
Yeah, I would say that I described to you the CCI, the Controller of Capital Issues, how we used to regulate. So from one extreme, we have moved to another extreme, and that is the free pricing which has been there. And unfortunately, when it comes to free pricing, nobody wants to leave on table money for the investor. I think the last issue which I remember, where the share price went up above this, and then it never went down, and that was the what is it called, that Mr. R.S. Damani's company, DMart. I think that share never went down. But I think the pricing is extremely aggressive, and it is not that the companies are guilty of it. Of course, the merchant bankers also, they I would say that my personal experience is that there is a competition among the merchant bankers as to who will get a better valuation for the company. And government is also no less. See, government also, when it is doing disinvestment, it is not leaving any money for the investors. 2%, 5%, that is nothing. I think if you look at Margaret Thatcher's example, the British government, they really, provided lot of incentives for the investors to invest when British Air, British Gas, and other such companies were delisted, were rather disinvested by the UK government, and it really brought about a revolution in the country when so many retail investors started participating in the markets. So I think that kind of initiative like LIC is going to be a very big opportunity for the government. If the government really wants, then it can give all kinds of incentives to the retail investors, and make them invest and come to the markets in a big way. As I said, the Jan Dhan movement for the markets, LIC is a very big opportunity. And if government can mobilize 25, 30 crore investors, then the markets in these countries will explode.
Okay. Next question is from Mr. Satve. What are the initiatives to be taken by stock exchanges to protect the investors' funds?
To prevent?
Protect
No,
the investors'
I
funds.
think you have to learn if you want to earn. I mean, I strongly believe that one must really be disciplined when it comes to investing. Stock market, stock exchanges are spending crores of rupees on giving education to the investors. But still, if you go to any investor meet, there will be people who will stand up and cry, "Oh, I lost my money here, I lost my money there." I think if you follow a simple rule of having a band in which you will invest, so like, for example, you bought a share, it has gone up from 10 rupees to 16 rupees. Do not ever delegate your decision to sell to anybody. I think that is one rule if everybody follows, because you know how much money you have in your pocket and how much loss you can bear. And if you set modest targets of 15 to 20% return, every time the share price goes up, and if you sell it off, then if you do it 5 times in a year, you can get almost 75 to 100% return. So, a disciplined way of investing is is very, very important. And I think that is the only way which will help you create wealth rather than diminish your wealth. So far, as I said, exchanges, everybody, so much they are doing, so many ads they are giving on TV. I do not think that that of course there is always scope to do more, but beyond a point we have to understand equity is a risk instrument, and risk is associated with it, and it is up to us totally on how to take care of that risk.
Okay, next question from Mr. Maya. What are your views on Indian market 5 trillion target by 2024? Also about emerging green sector.
I think, the way Mr. Modi is going about on import substitution, on various, setting up so many industries and all these things, I think we have a very good chance of achieving our targets. We all need to work hard in our small way, whatever we should contribute. And I think investing in the Indian markets is one of the ways where you can contribute to the growth of the nation. So I believe it is a achievable target according to me. And new sectors like the defense sectors and the rail sector, that is that fast train which is going to come up. We have a product investment baskets that we have, and our baskets which are in defense sector, and these they are doing extremely well because people understand that these are the industries of the future.
Next.
I think somebody is asking about gold, is it?
Ma'am, there's one question from Mr. Abhishek. He's asking, what's your thoughts on HDFC and HDFC Bank merger? How it will impact its stock? HDFC,
I mean, this was... See, both are very good performing shares. In fact, HDFC Bank has had an unblemished record of 20-25% growth for God knows how many quarters, and that is why it enjoys such a huge premium in the Indian markets. So this was something which was going to happen, and I think big is beautiful. So with a consolidated strength, I am sure they can do more business, and I am in favor of consolidation. So I personally feel that in the short run, whatever if anybody feels that it's not good, but in the long run, like we are merging all the banks also. Why we are merging? Because we want banks which are big in size and which can compete on the world front.
The next question is from Mr. Sudarshan. He's asking, ma'am, before COVID, gold was around 28,000, but in lockdown, it has increased as it was the only source many of them invested towards that. But after lifting lockdown and business also started, but still gold prices is very high. Why?
Now, I would say that I am personally also very bullish on gold. If you see last 5 years, gold has almost doubled. So gold is a fair weather stock. It is your hedge against all your difficulties in life. And now it has been made very convenient, the sovereign gold bonds, in which you also get an interest of 2.5% on the gold bonds. So I feel it's a great instrument, and it is liquid also. You can sell it off also if you so require. And I think in couple of years time, people are going to the jewelers will also start accepting gold bonds. So I feel there will be a more liquid market, and personally I am very bullish on gold. And why it has gone up, it has remained there. Obviously there is a huge amount of demand which is there, and at least some part of your portfolio one would always want to put it in gold. So that's how people have stuck onto it, and you do not see huge fluctuations in gold as such. Of course, once in a while it leaps up, but otherwise it is a kind of slow and steady. It cannot fall so suddenly. So I feel that it is a very good investment option. And please put some of your portfolio into gold. And according to me, sovereign gold bonds are the best bet.
The next
and
question
you also
is...
have gold also now. Digital gold is also available. So that is also a good platform.
Okay. My next question is from Dr. Netravati. Is asking, what is your opinion on new applications of investment in mobile phones? Without proper knowledge, how one can trust the investment apps? What precautions to be taken before trading through apps?
I think, apps as such are nothing but extension of the trading screens which are there in broker's office, or which you can have on a IBT, that is the internet-based trading platform. Of course, it gives you a lot of convenience, but of course, you have to be careful. But fortunately, the exchange systems are such that if you don't have money, if you don't have margin money, your transaction will not go through. So as a result of that, I think they are quite safe way to invest. Only thing is, because of excessive opinions and because of excessive information, because you can continuously see the movement of the price, you should not turn into a speculator. So long as you use it to make investments, I think it's a great evolution that has happened in the markets.
Next question is like this. Will sugar industry stock price increase due to demand of sugar in India?
See, I will not comment on specific this sugar. I'm not so familiar with that industry. Of course, I know people in sugar, the prices have been going up, but I am not up to date on that.
Okay. Next question. Leaving Indian stocks and we buying US stocks, will it differentiate the income that we make? Apple stocks, Tesla stocks, like this. Student is asking.
What I didn't understand the question. What you are saying?
Leaving Indian stocks and we buying US stocks, will it differentiate the income?
No. You see, every stock has an intrinsic value which is there, be it Tesla stock, Micro stock, or Amazon or Tata Steel. I think every share has an intrinsic worth, and we are fortunate that now enough trading platforms are available where we can buy foreign stocks also. But it is not that there are lesser opportunities in India. And I would say, unless you are familiar with the currency exchange rates and the cost which you are charged and all these things, you should be fully familiar with before you indulge into buying stocks directly on the international platforms. Of course, as a substitute mutual, there are some mutual funds which have floated international investing funds, so you can look at those till you learn the things properly.
The last question, due to the time constraint, this is from Sehaj. Sehaj is asking, according to you, who can create more wealth, trader or an investor? And as a teenager, what do you suggest we should do, trading or investing?
See, in 1982-84, after my CA, I did MMS from NMIMS. And they took us to visit the stock exchange. That time the new building was not built, it was the old building. And when we entered the building, it was having those quota tiles which were there on the floor. And we were told that under each tile, one speculator or a trader is buried. So many people have been buried because of being speculators and traders. Any day, it is investments which will win over. Even if you want to do a short-term investment for 15 days, 20 days, or 1 month, please take delivery and give delivery and do the trade, because leveraging is not good for anybody unless you are a very experienced investor with deep pockets. I used to have one investor who used to lose almost 2 crore rupees every year. He was worth, of course, 2,000 plus crore, and everybody in his family was very happy because he used to stay occupied right from 8 o'clock till 5 o'clock in the evening. From morning, he used to call up all the brokers, gather all the tips, and entire market time he was occupied. And being 95-year-old, his family members were very happy that he had so much interest in life and he was so vital. So I would say that, unless you have deep pockets and you don't mind losing money, I don't think it is advisable, especially if you are a student. please start an SIP. First, get a love for the market. What you do is take 10 stocks on paper, go on tracing those stocks. Look, why did it go up? Go on the internet, about the stock. If it goes down, go and see what happened. Then start predicting next week what will happen. Will it go up? Will it go down? And the kind of feel and the expertise you will get in understanding the market, I think that is a very valuable learning. You go through that process, and then I'm very sure you'll be a very good investor.
Thank you, ma'am. It was a wonderful session, ma'am. You have taken us through the real-time examples of benefits associated with shares and investments. Success stories of leading businessmen and investors have really made us understand the importance of security market. You have also spoken about the various opportunities on the same with an advice of caution for the investors. Thank you so much for this. On behalf of School of Commerce, Jain Deemed University, I heartily thank you for accepting our invitation and delivering such a wonderful session.
Thank you very much.
In investing, what is comfortable is rarely profitable, says Robert Arnott. At times,
So I can sign off, right?
yes, ma'am.
Yeah.
At times, you will have to step out of your comfort zone to realize significant gains. Know the boundaries of your comfort zone and practice stepping out of it in small doses. As much as you need to know the market, you need to know yourself too. Can you handle staying in when everyone else is jumping ship, or getting out during the biggest rally of the century? There's no room for pride in this kind of self-analysis. The best investment strategy can turn into the worst if you don't have the stomach to see it through. I now welcome our second speaker for the day and request Dr. Megha Garud, Assistant Professor, School of Commerce, Jain Deemed University, to introduce Mr. Abhilash Mishra, CEO, NSE Academy Limited, who will be delivering session on the topic, the global securities market, the changing landscape in academic perspective. Over to you, Dr. Megha.
Thank you, Dr. Ani Arnav. Mr. Abhilash Mishra is the Chief Executive Officer of NSE Academy Limited, a wholly owned subsidiary of the National Stock Exchange of India. In his previous assignment, he was Director, Global Outreach and Executive Education for India, Middle East and South Asia regions at University of Chicago Booth School of Business. He is an award-winning banking and financial services business leader with 25 plus years of extensive operating, sales, and marketing exposure at AXA Investment Managers, Standard Chartered Bank, ICICI Bank, and Aditya Birla Group. He is an expert at running joint venture alliances, has set up 3 business units, managed 2 M&A integrations, implemented multiple turnaround annual operating plans, and lean business strategies. He has an MBA from the University of Chicago Booth School of Business and is a Marshall Goldsmith certified executive coach. Thank you, sir. We welcome you and request you to take over the session.
Thank you so much, Professor Garud, and such a pleasure to be part of this conversation today. I congratulate StockBite and Jain University on organizing this very interesting seminar. And I welcome all the participants, the faculty, staff of the respective institutions also. It is indeed an honor to be part of this illustrious speaker line that I saw on the all 2-3 days that we are having this conference. Coming from an academic perspective and having spent many years in the banking and financial services in the country, I thought I will keep it as very easy flowing conversation. I don't have a presentation, but I thought I'll just take you across some of the important issues that we are facing today and where the past has been. How do we look at the present and where the academic and the industry perspective moves forward. It is often said that some of the most interesting developments in the capital markets or security markets or finance for that matter have come from the research desks of some of the luminaries in the academic field. And you don't need any introduction, be it behavioral economics or be it the Black-Scholes formula, be it the nudge theory. All of these have come from the research desks on some of the hypotheses developed by some of the brilliant minds in the academic world. I would love to believe that most academicians and professors, including some of our colleagues on this conversation today, are problem solvers. And hence, academics or teaching or research is a coveted profession for them because they believe that the insights, the interaction through the students, the work that they do with the industry, the research that they do around situations and problems helps not only interpret the past, but also have a crystal ball view of the future where the world looks like. It's not only in finance, it's also in medicine, it is also in industry. The research that happens in the universities or colleges gets taken to the marketplace. So a professor comes to a class and the professor has an hypothesis. He or she in the class presents it to the students, and the students then take these hypotheses or these experiments to the marketplace. And in any case, either they succeed and the hypothesis is true, it becomes applicable, or they learn. But in any case, these come back to the classroom. If we succeed, they become best practices. If there's learning, they become case studies for future. And through this entire process, what is most important is the data. How is the data behaving? How is the research being carried out? Who are the constituents? And how does it get interpreted over a period of time? So one, I would say that academics has the largest role to play, and a perspective on some of the path-breaking ideas in the industry, and securities industry is no exception to it, comes from the field of academics and research. So my heartiest congratulations and best wishes to some of the academicians and professors and faculty who are part of this conversation today for doing the path-breaking work and contributing to the markets. I'm breaking this conversation today into a few parts. I think the first part, which engages both the securities and the academic interface, is the policy. Some of the work that the governments do, the regulators do, the policymakers do, requires important decision making because it could have a everlasting and a deep impact, not only the market, but also the constituents and the eventual beneficiaries who are the investors. And that is where, if you see the public policy, the conversations that happen between academia, industry, and policymakers create that fabric to create an environment on which these conversations can happen, and the decisions could be taken, the regulatory perspective could be refined, and they could be implemented to eventually benefit the market. At the end of the day, any policy has to balance both sides. One which is looking at the interest of the beneficiaries, which is the investors, but also making the constituents, helping them in ease of business. And third is deepening and broadening the market so that the markets can absorb the shocks that happen either systematically through the economic behavior or through the global market conditions. So I think a role of public policy is very, very important to the research and the academic perspective. Some of the papers that you see that come out from this collaboration are really, really path-breaking. Coming to the regulatory side, regulators and NSE Academy is part of the National Stock Exchange, which is a frontline regulator. We work directly under the Securities and Exchange Board of India. And the two mission purpose that we as an exchange have is number one, bringing new generation of investors to markets. And second is providing those investors with fair and transparent intermediation. And that is the mission that the Academy performs for last close to 20 odd years now, and is to help our members, help the community, help the investors, either current investors or incoming investors, be it students, be it professionals, be it fresh investor in the marketplace, is understand the nuances of the markets, understand the risks, understand the behaviors, understand the various benefits in long-term wealth creation, and also understand the technology and the processes and the structures behind why and how the capital markets work. And a regulator's main objective always is to safeguard the interest of the investors. And I'm talking about the retail investors. And the academic perspective is very, very important to work closely with regulators, because research and industry collaborate together to bring new paradigm perspectives for regulators to take important decisions which help safeguard the interest of the investors and the stakeholders in the marketplace. So it's important that concepts on risk management, data, cyber security, in last few years, the way markets have evolved, even identification of or prevention of financial crimes, understanding economic offenses, these all are an important part of the regulatory oversight, and where academia also comes together to bring in cases, to bring in research perspective, collaborate on data sets, and ensure that mishaps or unfortunate incidents do not happen in the marketplace. And some of the recent developments by the regulators have really helped deepen this commitment that investors' interest and safeguards will be taken care of. Research is another perspective. Academicians have that framework, that methodology. Data is everywhere. Today, of course, with the digital economy, you can find data sets everywhere. And the more users and the industry and the stakeholders are on the digital curve, the data is going to be generated exponentially. 10 years back, 20 years back, probably the data points were not as much because technology was not developed. The more we spend time on technology, the more we spend time on the digital curve, the more the time is spent on the internet, data is going to be generated. So not only it produces data, but also it gives a lot of what you call support for that data to be interpreted. With the advent of the AI, the machine learning, the deep tech and future tech developments, new insights are getting developed, which benefit not only the industry, not only the regulator and the policymakers, not only the participants, but also the broader community also. Look at the advent and the development of the fintech industry in last at least 5 to 7 years. I think on the last count, there were 1,700 plus fintech organizations in the country of various sizes and scale. Right from do-it-yourself personal saving to stock investing to community-based lending and borrowing to credit to digital spending, digital wallets, transfer of money domestically and internationally. There are all kinds of fintechs available for every kind of need that is available in the marketplace. My father is 82 years old and he doesn't visit a branch. He does all his transactions on the app the banking industry has provided him. There's an example, and I recall very frankly, in early 1990s when the first ATM got set up, some of the younger students would not recall. For them, ATM has been a part of life, but we were just in college when the ATM got set up. So technology has played an important role in how today money transfer happens. Not only it provides ease of doing business, but also it provides various data points to segment the users, which is an interesting insight to provide right personalized services to the users on these fintech platforms. And that is where I say consumer behavior, marketing, the digital understanding of pattern recognition, all these come into play because the traditional set of marketing evolves on personalized services. And today the digital economy is providing that one as a consumer can benefit from the benefits of the artificial intelligence or the machine learning, because the more time we spend on these apps or these technology platform help us get personalized service, be it your personalized portfolio you put in your age and your risk preferences, your life goals, and the app provides you with a personalized future investment personal financial plan. You can look at asset classes, and not only they provide the insights into your future financial plan, but also provide you education and learning. From the NSE Academy side, we have an AI platform called NSE Knowledge Hub, which is a learning experience platform, and we endeavor every day to provide the best of learning to the users, to the learners, right from college to executives who are attempting or intending to not only even if not participating in markets, but also taking personal financial planning or personal finance or personal financial education as a part of the necessary life skill. So data is very, very important, and using technology to interpret data and do predictions, understand the depth and breadth of market. And the data can be used not only for interpreting the past, but also looking at the future, because two kinds of behaviors can be interpreted. One is the lead indicators in the market and the lag indicators. Mostly how consumers or investors behave in the marketplace are lead indicators, and those indicators can be used to interpret the lag indicator, which are the outcome of the market, be it stock markets, be it derivative markets, commodities, or any kind of asset classes which are available on the open marketplace. The next is the use of technology, as I mentioned. So fintech was one part of it. Technology also in ease of doing business, and technology becomes the equalizer. Look at how the access to securities market or simply the unbanked population, which didn't have access to even banking accounts or the stock markets or insurance or asset management through mutual funds, or simple credit to take for their own small business. Today, technology is an equalizer in bringing these unbanked, marginalized parts of the society, which are outliers, I call it, which don't have access to the traditional modern system of capital raising of funds for their small or medium size or micro businesses. Today, they are being brought together by the use of technology and fintech organizations, and they have access. Now, this provides access to capital, this provides access to credit, this provides them with safety and security. Otherwise, they were going to the traditional system wherein the money lender was charging high interest rates, and this all fuels the economy. This all fuels the growth of the entrepreneurial ecosystem, and this all provides participation to markets. And hence, it was no surprise when the Honorable Finance Minister recently in her discussion in the Parliament mentioned that the markets were able to absorb the shock because the retail investors were present in the marketplace. And I think that goes a long way to say that it eventually provides the impetus to the not only to the consumer economy, because consumer economy is fueled by purchases, but also to the saving economy and the investing economy, and eventually contributes to the GDP and the growth. I think that's a very important perspective we should look at. And some of these insights have come through industry and academic collaboration with the support of the regulators and the policymakers. Another aspect which, through an academic perspective, I would love to mention here is the creation of employability. India has the largest demographic dividend worldwide. And when we talk about demographic dividend, it is simply the age which is the earning population or the first-time earners. And the dependency ratio, which is basically the number of retirees over the number of income earners, is very, very low, which means we are a growing population, which is 16 to 60 years, which is the most productive population at the earning stream. I think we are the largest English-speaking, mathematically oriented graduate population anywhere in the world, which is entering into the first-time earning, into the earning world. And for all the students, youngsters who are on this conversation today, they couldn't have been a better time for all of us to seek employment. And it's not only banking or financial services, securities market, but simply access to some of the best technology, some of the best intellectual capital, and some of the best earning opportunities, be it jobs, be it entrepreneurship, opportunities are available. And I think they are working with the industry, creating employment opportunities and employability, taking the help of academic institutions to provide employability programs. At NSE Academy, we've been doing it for many, many years. Our work extends right from class 12th, where we work with state boards and CBSE on basic understanding of financial markets, creating courses with the higher education institutions across the country at BBA, BCom, and the MBA level, across banking, financial services, technology, and also providing employability programs wherein we work with some of the largest financial institutions, banks, insurance companies, NBFCs, and mutual fund companies to bring in employability opportunities to the first-time job seekers, but also provide upskilling, reskilling, and cross-skilling opportunities for the markets. And we've been doing it successfully for many, many years now. And we also have executive education and professional learning now. So that's an important part, that the academic and the markets, academia and the markets not only provide research, insights, data, public policy impact, but also provide employability. And if some last 2 years of data, which shows about the first time Demat accounts being opened in the marketplace, I think the recent developments in the markets have also given confidence to first time investors in markets to start looking at markets as an avenue to also create long-term wealth. And as the earlier speaker was speaking, is that first-time investors may not want to probably take the risk of dabbling into market directly, but through SIPs and mutual funds, taking long-term view of life insurance. By taking life insurance coverage when you're young, the premium is cheaper, taking health insurance coverage for yourself and the family members. These are all, benefits of knowledge, information, and the availability of or access to some of the technology platforms, apps available to you nearby. You don't have to walk into a bank branch to do everything, or it's everything available at a fingertip. I also wanted to mention here about the collaboration which is between the industry and the academia. There are a lot of areas in which industry and academia collaborate to provide not only research, but also future data points. Simple deliberations, creating those conversations, help look at the market, help look at the policy, help look at employability, and help looking at, because students today will be the future citizens of the country who will be participating in the entire growth of the nation and the global ecosystem. And with the internet, with the technology, the borders are opened up. It's one global economy now, unlike what was silos many, many years back. And it's not only the freedom of financial capital which is moving, but also the freedom to move intellectual capital. And it's a very interesting relationship where intellectual capital moves, financial capital follows, and also where financial capital is present, the intellectual capital follows. So, and the technology and the internet have provided that benefit to all of us. I think I will close my conversation now, and I'll be opening up for some question answers in the next 5 to 7 minutes. Is that, as I said, this is a very interesting period. Someone like me who spent last 25, 30 years, both in the industry and academia, and having the privilege of working with an institution of eminence like the National Stock Exchange and being partnered to this conversation today. Personally, for me, I say it's a fantastic opportunity for all of us to not only take the benefit of the robust ecosystem that we have, both on the regulatory, the public policy, the academia, on the industry side, but also as probably citizens of the future, the young generation. I would appeal to them and suggest them, think about ideas, think about ventures, or trying to become an entrepreneur to solve some of the problems that exist for the community, the society. And I think that will be a great way to reflect upon after a few years. How did the academic interventions and the academic insights that came from the university and the college world impacted the community and the society in general, and also benefited everybody over a long term. I'll close my conversation today. I hope last 15-20 minutes were useful to you. Thank you for inviting me, and I'm open to taking any questions right now.
Thank you, sir. It was a session which gave us a lot of insights on the topic. The participants can now ask their questions in the chat box. The link for the feedback form will be sent in the Zoom chat box and YouTube description box. You're requested to fill it and submit by the end of the session. The participants can post their questions in the chat box.
So should I look at the questions or someone needs to?
Sir, I will tell you the questions.
Sure.
They'll be posting in the chat box. I will take those questions and I'll post it. So there's one question from Kuta Bhaskar. This person is asking, is investment in NPS worthwhile investment?
Yes, absolutely. That's a good question. For a life goal perspective, personal saving for retirement is a very important life goal. Few years back, there used to be a defined benefit opportunity available for professionals both in the government and the private sector. But now, as of last few years, especially people in the private sector, there's a defined contribution plan opportunity available, which is part of the PF contribution that you make to the employer. But in addition to that, you can also voluntarily contribute to the NPS scheme and create a retirement goal plan that after retirement you will be able to benefit from that. Any kind of saving that you do, and NPS is a dedicated vehicle for that. So I would highly recommend, in addition to your other investment options that you have, and there are three kinds of life goals: long-term, medium, and short-term. Retirement planning is part of that long-term financial goal, and NPS could be one of the options that you can choose. And there are, I think, various, if I understand correctly, various options based on your risk profile that you have, the goals that you have. And after a certain period of retirement, you get benefit of steady income, and there are certain tax benefits also associated with it.
Next question. Is the ongoing Russia-Ukraine war affect any banking sectors in our country?
Sorry, could you, I have some disturbance at my place. Could you just a little louder, please?
Sir, in the ongoing Russia-Ukraine war, did it affect any banking sectors in our country?
If the question is, did the recent development in Russia and Ukraine impact the banks in the country? No, I don't think so. Again, I'm not a geopolitical expert, but if I, as a consumer of banking services, understand, our banking systems are pretty robust, well capitalized. The regulatory supervision and oversight is very strong, and I don't think we have to worry about anything. Yes, trade commitments and obligations do get impacted when there is certain restriction on trade with a particular country. But considering the way our banks over the last few years have developed their balance sheets and the kind of risk mitigation aspects that they have developed, I don't think there's an impact you will see anywhere.
The next question is from Mr. Manjuna. Should Indian government regulate the cryptocurrency market?
I very frankly have no view on that. This is a decision which has to be taken by the regulators, the central bank. Any asset class eventually has to, has to maintain safeguards, has to help manage the risk, and certainly the regulators have a very what you call a large and a fiduciary role to play in this. So, but the decision is there. I have no particular view, but I always believe anywhere where investors are participating in any asset class has to have oversight from the regulator, has to have risk mitigation measures built in, and it eventually helps everybody. It eventually helps everybody.
Okay. The next question from Mr. Sathwe. Which sectors in NSE sectoral index will contribute to growth of financial markets and economy, also to investors' wealth creation?
I again, as a representative of NSE, I will not be able to comment on this, which sectors are going to perform and outperform. And I wish every investor knew it and they could, create wealth out of it. Again, the long-term approach to any investment is diversification. If you have the time, ability, and the understanding to interpret markets, do your own research, take the help of a financial advisor, I think long-term approach is advisable always. Sectors will operate cyclically, but a diversified approach to the market always helps, especially for somebody for whom investment or trading or whatever you may call it is not a mainline vocation. Of course, people who do only investment as a vocation, as part of their full-time commitment, or do trading, they certainly have access to more information research. But for people like us, even for me, I cannot invest and I don't invest in stock markets. I only approach to mutual funds. I think I would rely on the advice of the asset managers, or the advice of my personal financial advisor, who would guide me based on my risk profile, based on my goals, and advise me solutions to approach for long term. And today you don't even have to probably buy stocks independently. You have, you can buy the index directly. You have ETFs. You have, diversified, actively managed mutual funds. All of these provide you opportunity. As again, I would reiterate the point: if you don't have investment or trading as your mainline occupation or vocation, it is best advisable to take the advice of a financial advisor and a specialist in that regard.
Okay. Next question is from Dr. M. Franklin. What will be the impact of US economic sanctions on India for our continuous trade with Russia? What
Again, I
will
would
be
say
the impact of
this is a geopolitical issue question, but if I may just as an observer make a point here, India is a highly robust economy now. The regulatory, the policy, and the trade, what you call developments in last few years have brought us to a very stronger position. While of course the trade balances between imports and exports always will play a role depending on different geographies. But if you see, India is not only just restricted to US, but we have broader and larger and deeper relationship with other economies in the world also. The recent agreement with Australia, are a sign of the diversification that we also as an economy are doing. And I think for a stronger economy like us, for a growing economy like us, with a much respect in the global marketplace, as a global player, while they might be, again I will say as an observer, not to be quoted, but I think we are in a stronger position now, and the development certainly do impact every country, but I think for an economy like us, we should be able to sail through strongly.
Okay. The next query is from Dr. Sarvana. What are the main parameters we need to check while selecting to buy a stock like P/E ratio, book value, dividend, etc.?
I'm not eligible to give any advice on this, but all of these ratios are important, depending on what you're looking at. There are basic thumb rules which everybody follows. And again, I would suggest whatever you study in your class to value instruments in your finance class or your commerce classes, all these ratios are important. How do you want to interpret those ratios for what important matter? What is your time horizon? What is the kind of industry you're looking at? What is the sector you're looking at? But again, I would say this will not come down to personal advice for finance. All these ratios are important depending on what objective you are looking at them to. But again, I would say I would leave it again to the experts. I'm not an expert on stock picking or funds. I will leave it to the asset managers to manage it for me.
Okay. The next question, sir, by Mr. Manjuna. Is there any impact of HDFC Bank acquisition? Just a minute. Is there any impact of HDFC Bank acquisition of HDFC on Indian banking sector?
I won't have view on that. I'm sorry. I'm not eligible to or qualified enough to answer that.
What is your thoughts on India launches cryptocurrency?
Again, I would say India is part of the global ecosystem. This is a question that has to be asked to the regulators and the policymakers. If the central bank feels it's the right time to have your own cryptocurrency, I'm sure the decision will be taken by them. It's an asset class. It's a parallel currency. I'm sure the central bank will take the right view depending on what our position is in the global ecosystem.
The last question, I think, again, it points on the sector. I don't know if you can answer. So banking stocks which are coming down, will it affect the loan system, which real estate, automobile sectors have connected with the banks?
I am not an expert. As I said, I'm not a research analyst on stock picking. I just help individuals and organizations reskill, upskill, and qualify themselves for financial education. These questions could be well put to some of the experts who are more qualified to answer these questions. But I'm really impressed with the kind of interest our audience has, and some of these questions are very, 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 very pertinent. But unfortunately, I'm not the right person to answer them.
Okay, sir. With this, we'll close the query section.
Thank you so much for inviting me. Wish you all the very best.
It was knowledgeable an overview of fintech industry and changing landscape, advent of technology and ease of business with different platforms. Thank you so much for that. On behalf of the Faculty Research Cell, Samshodhana, School of Commerce, JNTB University, in association with Stock Market Institute, I deem it my privilege to thank and extend a heartfelt gratitude to the speakers for spending your valuable time and enriching the session and knowledge of the participants. Thank you, sir.
Thank you so much.
I request the participants to fill the feedback form, which is posted in the chat box. You can see in the Zoom chat box as well as YouTube description box. Thank you.